Hello, my name is Paula Reinoso. I'm the Regional Account Manager for Spain and Portugal at STR. I'm here today to talk about STR benchmarking tools and hotel trends in Portugal. For the agenda, I will start with an introduction of STR and our benchmarking tools. Then I will move on to Southern Europe regional update with a global overview first, to finish with Portugal performance and what's next according to our new forward start data. STR has more than 35 years in the market providing benchmarking services. We collect data from 180 countries from around 68,000 hotels in the world, representing more than 9 million rooms. And in Portugal, our sample is around 200 hotels, and in rooms, we have more than 29,000. We are the one-stop platform for hospitality performance data. We collect available rooms, rooms sold, and rooms revenue from hotels to send them back their reports with the key performance indicators for their market and competitive sets, with occupancy, ADR, RevPAR, supply, demand, and revenue. We also collect forward data and profitability data. We do research, study supply within the industry, provide many types of analysis, and offer forecast reports for more than 40 markets globally in partnership with Oxford Economics. Our partners go from the big international chains to medium, smaller hotels, companies, and independent hotels. They trust STR with their highly confidential data over the years for the benefit of the industry. STR has strict rules to protect the confidentiality of individual property data, brand, or parent company. Now a look into STR benchmarking tools. So why competitive benchmarking? We have here two managers looking to any of their performance indicators, percent change versus same time last year. Who is doing it better between these two managers? It looks like manager A is doing much better than B. But what happens if I now show their competitors' performance? We now can say that B is managing better the hotel in maybe more challenging market conditions. We need reference and perspective. It is good comparing to last year, but what could we doing better? How much better or worse we could be? Let me talk about our digital platform, D-Star, for hotels providing data to STR. Hotels submit their daily, monthly data to us, and they receive complimentary daily, weekly, and monthly reports with the comparison of their performance versus their market or industry segment. And if they wish, they can upgrade to a competitive set, which is a group of hotels specifically chosen by the subject hotel. This has to be a minimum 4 hotels. If they do so, on top of occupancy, ADR, and RevPAR, they also receive the ranking, that is the position of the hotel within that set. Monthly reports show historical data for the last 18 months, 3-year trends comparison year to date or for multiple time periods, plus day of week or weekday and weekend analysis. They have the option to participate with extra data points like rooms data, segmentation, and additional revenue to track total RevPAR and total RevPOR, so total revenue per available room and total revenue per occupied room. Hotels receive an email notification, and straight from the email with a secure username and password can log into the digital platform to access charts or tables available to export in Excel. And now we can also benchmark into the future. Similar concept as with historical data, If you participate with Business on the Books data, you receive the comparison versus market data on a complementary basis, and you can also upgrade to have a competitive set. Reports are sent weekly showing occupancy on the books and pickup for the next 90 days, and in a monthly report, the same information but for the next 365 days. This happens the first week of each month. It is a simple report. Data comes directly from the source to give full view of occupancy on the books across all channels. We can automate from the PMS, RMS, or BI tools, and we have a whole team that helps us to facilitate these automations. Moving now to the hotel trends outlook, I'm going to be showing data for 2020 full year performance. Despite a year that many of us would like to forget, there are always lessons to be learned. Looking at the international landscape to better understand the global situation, we have here standard occupancies across all subcontinents, ranging from 27% in Central America to 49% in mainland China. I will stop here to explain standard occupancy versus total room inventory occupancy. With the strain in supply because of the pandemic making hotels close temporarily, STR introduced total room inventory metric. TRI tracks total room stock within a market regardless of the operational status, so if it's temporary closed or open. While standard occupancy excludes all the temporary closures. If you are a hotel operator, standard occupancy is the one to look at. It shows actual performance of the open hotels. If you are an investor, developer, or any financial type, TRI is for you because it describes potential market performance or how demand spread out over every single hotel in the market. The base supplies is bigger in TRI, so TRI occupancy is smaller. In 2020, total room inventory occupancy ranges between 18% to 44%. Eventually, when all the hotels reopen or close permanently, the occupancy will go back to one metric. The next slide is showing RevPAR percentage change for the full year 2020 versus 2019. Europe ended 2020 the same as most of the other regions with record low performance. RevPAR sank to a mere 30 euros in Europe. If looking based on total room inventory, majority of the markets were down by more than 50%, and Europe, the bottom performer, dropped 72%. This slide is showing open rooms per continent. 9 out of 10 hotels were closed during the first wave of lockdowns in Europe. April was the worst performing month for the year as occupancy decreased to 11%. Things started to look up for Europe as the summer rolled around and these restrictions were eased. Open rooms in Europe reached 93% of pre-pandemic levels, but the second round of lockdowns came into play and hotels had to close again. However, this time 80% of rooms remained open. Looking at the open rooms per country, Portugal and Spain had the same trend in the first lockdown with only 15 and 17% of the rooms open respectively. Portugal recovered better during the summer months than Spain, but now again is just a few points behind with 90% of rooms opened. However, far from the 15% in the first lockdown. Poland was the outlier here as the country fell to just 50% of rooms open in early January 2021, but climbed back to a higher percent in February. Total room inventory occupancies for Portugal and Italy were at 19%, bottom of the pack in Southern Europe. They are very reliant on international demand, which was the most affected by the travel restrictions and cancellation of travel corridors between countries. To put these occupancies into context, Southern Europe had a TRI occupancy of 21% and a standard occupancy of 30%, much bigger gap than other regions, given the level of temporary closed hotels in Southern Europe. But looking at RevPAR percentage change, standard metric is when our hats plummet. We can quickly see that the leisure summer destinations outperform the gateway cities, following the trend that we are seeing across Europe. Canary Islands, Algarve, and Turkey were top performers. Note that Turkey in this slide is in local currency, therefore much lower year-on-year percent changes. Going into more detail in terms of the regional markets versus capital cities performance analysis, regional markets were clearly ahead in standard occupancies than their capital cities as soon as restrictions were lifted a little. Hotels benefit of the transient and leisure business, and markets with a larger domestic demand benefit more. But what is interesting to see when looking at ADR percentage change is the resilience in rates in general in these regional markets. Portugal, a case to highlight, and I will be showing more in the next slides. But here ADR dropped only 3.7% when excluding Lisbon from the rest of the regions. Like I mentioned before, performance was better in holiday destinations in Southern Europe. Canary Islands, south of France, Turkey, Algarve. In rates, Algarve is the third top market with an ADR of 130 euros behind Paris and Italian islands, which are markets with another level of rates historically. Anyway, Algarve outperformed Balearic Islands in rate and occupancy, which did not happen in 2019. Now, diving deeper in Portugal performance. Portugal clearly suffered from the travel bans and restrictions, like many other countries in Europe. Occupancy decreased by 64%, however, ADR percent change dropped by 11%. In Spain, the drop was around 20% to have a point of reference. If we look at occupancy rolling 7 days for 2020 versus 2019, we can see the gap in occupancy, how Portugal recovered in the summer, but fall back again after the second round of lockdowns were introduced, and occupancy currently is still struggling at only 10%. The worst occupancy performance happened in April 2020 with only 5% occupancy, and the best occupancy since the start of the pandemic was in August at 40%. Moving to market level performance, Southern Portugal regions are the winners. As highlighted before, Algarve's average daily rate ended at 130 euros, and Portugal South ended with the highest occupancy at 29%. It shows again the contrast with Lisbon with ADR at 94 euros and occupancy at only 22%. Portugal North, a little better in occupancy, but much lower in ADR at 76.5 euros. Moving on to the class performance, looking at the overall result in 2020, of revenue per available room percent change by classes, higher end classes in Portugal outperform mid-scale and economy. As we saw, Europe was the epicenter of the hotel closures. As sources of demand changed, this impacted hotel closures by class. Luxury hotels, normally with bigger meeting space, golf, and spa amenities, higher operating costs, that rely heavily on business and group demand, had to close when this type of demand vanished. Maybe less available hotels in the market could have benefited the ones that managed to stay open. More mid-scale and economy hotels stay open in general in the regions when looking at closures. They capture some non-traditional demand like key workers, locals having to isolate or quarantine on top of the remaining transit and leisure demand left, but this differs in different markets. At sub-market level, we found the driver for the positive ADR growth in Algarve. 10% increase in Albufeira, and in the rest of the Algarve it's flat and 0.1% increase. So no change to 2019 levels, which is remarkable. In Algarve, occupancy was 25%, ADR 130 euros, and a timid 33 euro in RevPAR, above the average in Europe of 30 euros. Looking across 2020 versus 2019, occupancy rolling 7 days, it shows the big gap in demand compared to previous year. Top occupancy was hit the week of the 27th of August at 72% compared to 93% the previous year. And then you look at the same time period, but actual ADR rolling 7 days, and it's pleasant to see. Good news, as we're predicting a stronger summer than in 2020. So with better conditions for traveling than last year and continuing to hold the rates, this year has to bring better performances. So now looking ahead, according to Forward Start in Southern Europe. Looking at country level first, occupancy on the books for the next 365 days as of 3rd of March 2021, Portugal does hit double digits through July to September, with a peak on the 28th of September at 21%. Comparing Lisbon with other European cities, we can see that travelers are still planning for events and booking hotel rooms in advance. Lisbon hit 31% on the 27th of September as of 1st of March, when several medical and pharmaceutical congresses are being planned. Regional Portugal, following a similar pattern as Balearic and Canary Islands, hitting 20% occupancies beginning of July and the end of September. So for the end of this presentation, some thoughts to go. There is a saying that before things get better, they will get worse, and looks like this is how it feels in Europe. We need to be patient and resilient. We need to control costs, stay open if possible, so you can be ready for the summer months. Recovery should start with the domestic demand, and those that get business first will likely to keep it. Summer should see a splurge of pent-up demand, so this is the good news, and leisure destinations likely to benefit most, like Algarve. The long-term changes in demand structure will be clear at the end of this year, so we need to adjust strategies accordingly. So thank you very much for joining this presentation. Any questions you can have, you can contact me at my email address here. And I hope you enjoyed and have a nice afternoon. Thanks.